I want to thank you all for joining us again for another episode of Cam Harvey's Through the Noise. And I just want to get right into it. The last episode we had, we went in depth a bit about gold, a topic that you know a lot about. And we talked a little bit about how it's been stable over time. You look over the long history, and you said something about a correlation between the price of a loaf of bread today and back in Nebuchadnezzar's time. And yet, on January 30th, 2026, we saw an 11% drop in gold. And I'm curious, can you help me understand that a little bit?
Yeah, so this was extreme volatility. And just to give you an idea of how volatile that day was, that usually with about 95% confidence, we see gold fluctuate, let's say, up to plus 2% or minus 2%. So an 11% drop, that is a very big move, and you need to go back to the 1980s to see something as dramatic. So this was a very significant move. However, you need to put this in context. So number one, even though gold crashed, gold year to date has a positive return. So December 31st, 2025, the price of gold was $4,300. And if we look over the past year, indeed, I wrote this paper in April of 2025 called Gold 5000. At the time, the price of gold was $3,000. So if we look over the last 12 months, the price of gold, even after this crash, is up 67%.
That's wild.
Yeah, so this is something you need to take into account. And I think that if you put it into perspective, what's really anomalous is what happened before the price crashed.
And what happened before the price crashed?
Yeah, so it's really interesting going through kind of the daily dynamics of what was happening to the price of gold. So mid-January, we crossed the $5,000 mark. And psychologically, maybe that's a big deal. It certainly got written up in the media. And it kind of hung around the $5,000 mark. But then on Tuesday and Wednesday, it's the 27th and the 28th, all the way through the 29th, which is the Thursday, the price of gold went wild. So it went up by 10%. And not just gold, but silver also. And indeed, I noticed something, and I showed my students, and I said, beware of this. And it had to do with Chinese buying of silver. So in China, there's only one exchange-traded fund for silver. And it had so many orders that that fund was trading at a 54% premium to the silver that they were actually holding. So people willing to pay 54% more for that silver. And I'm looking at that saying, this is like a feeding frenzy. It's not just gold, it's silver. People think the silver is the new gold. And what happened, it drove the price up from approximately 5,000 to 5,500 in a very short period of time.
What you're describing is a lot like a mania, like the manias that we've talked about, the tulip mania and other manias. That's what I'm hearing.
It's not just that. It's think of it as like a meme stock or a meme token. That was the kind of behavior that was happening. And we got a very substantial appreciation that was inexplicable. And then the correction. And that correction started about 7 p.m. on January 29th, and then it went all the way through January 30th.
When you talk about meme stocks, so you're saying there must have been some sort of social network that this was going out around?
Oh, yeah. This is the retail investor. So let me explain kind of the dynamics of the trading. So the retail investor is largely an investor that we call a momentum investor. So if prices go up, then they buy. If prices go down, they sell. So Warren Buffett likes to call these investors bandwagon investors. So as the price is going up, these investors jump on the bandwagon. And as they jump on, which means buying, that actually increases the price and kind of validates their investment thesis for a while. And the for a while ended on January 30th. So it's also important to understand the interplay between the retail investors and the institutional investors. So institutional investors also trade a strategy called momentum. And that means you're buying when the price goes up and selling when the price goes down. However, their models have an important difference. So if there is a very rapid rise in prices, then they reduce their trade size, thinking there's going to be a correction. Think of it also like taking a profit. And that's what I believe happened on January 30th. The institutional investors stopped buying, if not selling. The price started to fall. And then the retail investors started to dump. And this was made even worse by the retail investors that had levered positions. They got margin calls. And if they didn't put the margin up, they were liquidated. And that liquidation, that selling, kind of fed into the crash.
So something that starts as like a psychological thing turns into a mechanical mechanism, which accelerates this.
That is exactly what happened. So both the run up and the run down. So the way I look at it, it's characterized as a crash, but really I think it's more of a correction. So to me, a crash would be much more severe and not as kind of short-lived.
So when something anomalous like this happens, what I find curious is to look into the news and see what stories are being told, whether true or not. So what are the stories that you're hearing to talk about why this happened and, how truthful are those?
Like the main story is the appointment of the new Federal Reserve Chair. And the nomination actually somehow leaked out, and Polymarket, the prediction market, the probability of Warsh being nominated went to 95% at 7 p.m. on Thursday, January 29th. So people actually look at that point and say, well, this is because of the nomination of the Fed chair. I think it is a red herring. So what was happening before. So this extreme run-up in the price of gold over a very short period of time, that happened beforehand. The correction just happened to coincide. People, of course, can tell stories, but I don't think that's the real story. The real story in understanding what happened to the price of gold is in the role of the retail investor and the institutional investor, pushing the price up and then the price correcting.
That's great. And this is consistent. I want to remind our listeners that we have an episode about the Fed, and this story is very consistent with what you had shared with us then. So I want to thank you very much for these brief insights on gold. I'm looking forward to something crazy happening next week and us talking about it then.
Very good.